Good morning from London. I'm Anna Edwards alongside Guy Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Stocks hit a new record as investors bet on a Fed rate cut this week. President Trump's governor pick, Stephen Miran, is confirmed, but his bid to fire Lisa Cook is blocked. Chinese leader Xi Jinping and President Trump plan to speak on Friday in the first direct engagement between the two since June. Plus, Google announces a £5 billion AI investment in the UK. It comes as the US president is set to unveil $10 billion of deals during his state visit.
And it's looking like another positive session for the equity market after another record close over on Wall Street last night. S&P futures in the green. Euro Stoxx 50 futures up 0.2%. It gained almost 1% yesterday. Euro dollar at 117.80. The dollar is hovering around a 2-month low ahead of this Fed decision, and those 10-year Treasury yields at 4.04, also hovering around year-to-date lows as we head into that Fed decision. The countdown to the opening trade starts right now.
Tuesday the 16th, good morning. Coming into this week, I thought the Fed would be the biggest risk event of the week. I'm beginning to wonder whether or not that is still the case. Yes, the Fed is going to be interesting and exciting, and there's going to be some fantastic coverage coming up and conversations on this show. But I'm just beginning to look ahead to what can happen with this call on Friday between Trump and Xi and wonder whether or not that has the potential. You've also got a Starmer-Trump press conference Thursday. That could be entertaining as well. But the Fed is firmly in focus this morning. We start the meeting. Everybody's got a chair. We're good to go, Val.
Yeah, full house of governor seats being sat. We have Lisa Cook, who the court yesterday ruled that she can stay on as governor while they're judging the merits of the case. And then Stephen Miran basically setting the land record for getting confirmed in just over a month for this vacant seat of Adriana Kugler. So it does look like we're having a full house as the decision in the meeting begins today.
Yeah, it does seem as if that President Trump could still call on the Supreme Court to take some action around Lisa Cook, couldn't he? But we continue to watch that. Bloomberg Intelligence suggesting even if that happens, she still has a 60% chance in their estimations of staying in the seat, but she's holding on tight for now.
It was very interesting to look at the ruling. The ruling for Lisa Cook, they said that Trump violated the due process law by not giving her enough heads up and essentially trying to fire her via social media was probably not the correct route he should have gone down. They didn't necessarily judge or weigh in on whether Trump had cause to dismiss her, but I guess we might have to wait for the Supreme Court to weigh in on that final decision.
It was interesting how it went down political lines as well, which may tell you something about how we should think about the Supreme Court that is coming.
And there were only 3 of them, weren't there? So we're 2-1, and there were 2 who were appointed by Biden and 1 appointed by Trump, and as you say, they voted as you would have guessed they might.
So now what? So what are we now looking at? Because actually her seat, and John Authers, who I'm hoping we're going to be speaking to a little bit later, makes some really interesting points about the fact that her seat is really critical in terms of the unfolding Trump plan to take control. If he can't get rid of her, he's going to struggle to take control of the FOMC in the way that he had anticipated. So actually, Lisa Cook's court case, I hadn't quite appreciated the nuances in terms of how significant it could be in setting the table for lower rates and the Trump takeover.
Yeah, I mean, he has a really interesting point on that, doesn't he, John Authers? So it'd be good if we can speak to him later on. But it'd be interesting in just the very short term, Valerie. I mean, the dot plot, we've got Stephen Miran. Will his dot be very easy to identify on this new dot plot? I mean, that's going to be one of the things we're going to be doing, circling his dot.
I mean, I hope he's prepared his response in the summary of economic projections. I mean, these normal things take economists, a few weeks to put together where their dot's going to be, where their unemployment forecast's going to be. So I hope he's
got the whole of the White House to call on.
Yes, he does. Maybe he does. And that was actually, funny enough, in the voting yesterday, there was a Republican who did vote against his nomination, and they did raise the fact that they were upset that Miran hadn't fully resigned from his White House posting, just taking a leave of absence. But in his argument, he doesn't want to go through the confirmation process all over again if he goes back to the White House in January.
Do you want your job back? Do you not want your job back? Vote for a rate cut, you're good to go. Like that, it's got to be the thought process that is happening here. Let's turn to China, because actually I'm beginning to increasingly think that actually the China story could be the one that ultimately sets the agenda here. How many meetings have we had now? Is it 4 meetings between Besant and his Oppo?
In Europe.
In exotic locations.
In very exotic locations.
Where to next?
Yeah, I know. That's the thing. And there probably will be a next. And that's the important point here, is that we've had all these meetings. And what have we got to show for them? an agreement on a social media platform. It looks like a framework agreement on a social media platform.
Well, there is progress. You could say they haven't necessarily hit a stalemate. It does sound like there's progress. Even Bessent telling the media yesterday that they want to hold trade negotiations again in about a month in a different European location.
Great. So we'll have another meeting, and we're working towards another deadline rollover, which is probably going to happen in November. We do then have a TikTok deal, which I think is significant and does set up the call that looks like it's going to take place on Friday, which is a precursor, it seems, to the meeting at APEC, which actually increasingly feels like it is the route to progress. We'll see to whether or not that ultimately ends up happening. But it looks like Oracle's going to be involved. Oracle, we knew, was probably going to be involved. Its stock was up late in the day yesterday, so that is another positive for Larry Ellison, boosting his stock price even more, as you can see. That was the impact on the Oracle price yesterday. So it looks like it's going to unfold, but we still don't have... This is a framework deal.
Yeah, I mean, and if
details are missing.
If it takes this long to agree on one social media platform, I mean, this is what is involved with, to some degree, micromanaging in an economy, isn't it? You know, this all takes time. It takes bandwidth. It takes administrative officials to be behind the scenes, you know, crunching the numbers whilst you're having these face-to-face talks. And so it is interesting that we have spent so long getting to some progress on one social media platform, and yet November is the deadline, isn't it, to extend further the kind of stalemate that we have around the tariff situation, because that still lingers in the background. If there were to be a falling out between these two before November, we could be back to much higher tariff regime.
Yeah, it was interesting that Bessent yesterday said that China had aggressive asks without going into detail about what that was. Probably not related to TikTok, given that they made progress on that, but perhaps aggressive asks when it comes to chips. You know, we know that they had that lawsuit against NVIDIA about their monopoly, a ruling about an antitrust case happening in China.
The mood music between China and the US has actually got worse, not better, over the last few weeks. Like, it doesn't seem as if actually relations are improving in any
NVIDIA,
precisely.
Yes, has been pretty negative, hasn't it? Talking about getting a tough time in front of the media, or maybe not, let's talk about President Trump in the UK, shall we? He's going to be bringing with him some deals. He'll bring with him a lot of leaders from business over in the United States. $10 billion worth of deals is what one US official has been telling Bloomberg we should expect around science and technology, defence technology cooperation. Financial services could be in focus today. Rachel Reeves, Bessent are going to be meeting, and financial services is going to be the focus there. President Trump and his large team, so Rubio's here, Bessent will be here, Witkoff will be here, all of the team will be in place. They all want to meet the king, have the pageantry and the big state dinners, and all of that will be happening. The thing is, the UK media doesn't want to talk about all the things I just listed. The UK media, and they will get a chance to put questions to President Trump, will want to talk about Epstein. They'll want to talk about steel tariffs. They'll want to talk about all the other things that are missing, whiskey, that are missing from the trade deal. They'll also want to talk about President Trump's views on the UK rise after that Unite the Nation rally took place under orders from Tommy Robinson. So what are his views on that? And so all of these things could get quite fractious as we get towards Thursday, is the press conference.
Thursday's the press conference.
And for the rest of the time, they're trying to keep President Trump away from the public, is the aim.
And away from London.
Yes. He'll be flying, apparently, from certain parts of the UK.
That does seem slightly logical. If he's not coming into London, why would you come into London?
Yes, this seems like
that does seem like a fairly sensible strategy. The UK data we've just had dropping onto our screens in terms of the employment numbers doesn't seem to sort of change the narrative a great deal in terms of the outlook for gilts, which will be opening in around 50 minutes' time. So we'll see what happens with that. But it does seem as if the wage data and the employment numbers, believe them if you will, look fairly stable at the moment.
Tiny tick up in the pound. But, you know, only if you're really looking for it.
Squint, and you can see it. What else have we got coming up on the show? Shri Kochigovadan is going to be joining us from Aberdeen, senior research economist there. We'll talk about all the things we've just been discussing. Siobhan Haviland, British Chambers of Commerce Director General, talking about what the Trump visit could bring to the UK. Bilal Hafiz, Macro Hive CEO, joining us. 25 or 50, the conversation there. And Peter Westmacott, former British ambassador to the United States, a little later on in the programme.
And taking a look at risk events on the horizon coming up today, 9 a.m. we have the German ZEW survey, and then the attention goes to the U.S. at 1:30 p.m. UK time. We have U.S. retail sales, arguably one of the biggest economic data prints of the week as we head into that Fed decision. At 2:15, we also have U.S. industrial production. The Fed meeting does start today, as we mentioned, with full sheets when it comes to those governors' seats being taken now. And later this evening, Trump does arrive in the UK around 8 p.m.
The way to arrive at the UK is definitely at Stansted Airport.
better experience.
That's where he's landing.
I imagine he has a fairly different arrival experience from the average Stansted passenger. Maybe that's the case. From a market's perspective, Valerie, retail sales, that's the hurdle to get through, or not much of a hurdle, given how high expectations are that we get this cut?
Look, a cut is very likely, but this will probably just weigh into the debate on how aggressive the easing cycle is likely to be. It'll be a good gauge on how consumer activity is faring in the third quarter. And remember, retail sales feeds directly into GDP, so it's just a really good showing of how U.S. economic growth is holding up this month.
There's some calls out there, Standard Chartered, various others, for 50 today, and then a much more cautious stance going forward. So is it
last year?
Yeah, precisely, and that's the point. Do we get the kind of repeat of what we saw last year, and what effect would that have on market psychology? We're all kind of going down this 25, another 25, another 25, but maybe actually there's different permutations. We'll talk about those throughout the show. What else do you need to know this Tuesday morning? The US President, Donald Trump, is bringing, get this, a $15 billion defamation and libel lawsuit against the New York Times. In a post on Truth Social, the president accused the publication of becoming a, quote, mouthpiece for the Democratic Party, citing its endorsement of former presidential candidate Kamala Harris, amongst other concerns. In his post, he also references previous litigation with other news networks, including ABC and CBS. And staying with the president, Wall Street's main regulator says it's prioritising the president's call to reduce the frequency of corporate earnings reports. The Securities and Exchange Commission says it's pursuing a proposal to further eliminate unnecessary regulatory burdens on US companies. The SEC has mandated firms to report quarterly since 1970, after a decade-long push to increase transparency following the 1929 stock market crash. Love a bit of history. UBS is facing a $26 billion increase in its capital requirements from the Swiss government. That's prompting the bank to consider various options to meet those new rules. Options range from technical tweaks to more dramatic moves, such as an M&A deal with a non-Swiss bank, or slimming down its business units to reduce assets. That's after Swiss lawmakers voted yesterday against a second attempt to delay stricter bank capital quality rules.
Coming up on the programme, the Italian government is said to be drafting plans to raise an extra €1.5 billion from domestic lenders in 2027 by postponing their tax deductions. Plus, Bloomberg has learned that Verisure is eyeing an IPO as soon as this week, kicking off what could be Europe's largest listing in some 3 years. We'll certainly talk about the IPO's resurgence. But up next, it's a big week for global central banks. We dig into what to expect from the Fed, the Bank of England and the BOJ. If you have any questions, if you do want to have your say in any of these conversations, IB plus BBTV Go, that's the function to use. That puts you in touch with the team that puts together this programme. This is Bloomberg.
60 minutes past the hour. Welcome back. You're watching the opening trade. So the US economy is apparently slowing, but the stock market is at record highs. Financial conditions look fairly easy. What is the Fed going to do a little bit later on today? Well, has all the answers.
So record highs for the S&P 500 yesterday, crossing the 6,600 level for the first time ever. And Guy, we're less than 6% away from hitting the 7,000 milestone for the S&P 500. 73 trading days left in the year. Let's see if we can get there. But it's been the earnings momentum and the decline in front-end interest rates has really helped out the equity market of late. It's also been helped out by the tech trade. Take a look at the NASDAQ on a 9-session winning streak, the longest since 2023, and a lot of this has to do with the surge in Alphabet since the beginning of September. It's up 20% since September 2nd and added $500 billion to its market cap in that time frame, now becoming the fourth U.S. tech company to surpass $3 trillion in market cap. That is one statistic to keep on your mind as this tech trade rolls forward. But keep also in mind, we do have the Fed meeting, so possibly some volatility on our hands, but implied volatility, at least in the bond market, has dropped to lows not seen since 2022. This is the the Bank of America Move Index that I'm pulling that statistic from. Treasuries have been testing their year-to-date lows, but this is all in the back of a drop in implied volatility. The market is just more comfortable pricing in this easing cycle that the Federal Reserve is about to kick off. Guy?
Absolutely. What kind of a cycle are we going to see? How long does it last? How deep does it go? Shri Kochi-Govardhan, Senior Research Economist for Aberdeen, joining us around the table. Good morning.
Good morning.
25 today? Tomorrow?
Tomorrow.
Starts today.
Tomorrow. Starts today. It's announced tomorrow. Yes, I think so. I think it's very much expected by the markets that it will be 25. I think the discussion, the press conference afterwards will be very closely watched. Obviously, we have Stephen Miran joining as well. Lisa Cook will be there as well. And I think there'll be some discussion of a 50, possibly. I think it's a high bar for a 50, but 25 is pretty much nailed down, I think.
Then what?
Then we actually think, given the movements in the labour market, they have been prioritising labour market over inflation. And I think what we're seeing there, that trend, that weakening, is enough to justify further rate cuts. So we have now shifted our call to 3 cuts this quarter. So 25 this week and another 2.
And then 26?
In 2026, I think there could then be a slower pace if there is further easing. Then it's a case of really focusing on the balance of risks. I think right now you can think of it as insurance cuts because the labour market is weakening. But next year, remember, we still have the impact of tariff starting to filter through. You can see those import-intense factors are starting to look pretty hot in terms of inflation at the moment. So that'll continue to filter through.
Okay.
Yes, they'll look through it. They'll say it's transitory, but I think next year they'll pause a bit.
It's not an exact repeat of last year. We've got insurance cuts. Here we go.
Yeah.
Or as a Standard Chartered, we're calling them catch-up cuts, I think, because of the changing jobs picture, the updates to the jobs.
It feels very similar to the way to the picture.
Yes, exactly. The 50 basis points, before around the election time, wasn't it? Just before the election, this time last year. So from what you've said, Sri, in terms of your expectations, you wouldn't expect the Fed then to push back against market pricing of further rate cuts because you're expecting, like the wider market, to see those further rate cuts come to pass.
Exactly. So for this year, yes, I think the 3 cuts this quarter, they won't give away this is the timing, this is the magnitude. But it'll be difficult to see how they will push back against that, and they'll just say that they are data dependent. But I think as we move into next year, they're likely to see a slower pace and really, maybe moving to more of a quarterly cadence if there are further cuts to come.
What kind of bar would it be for Powell to tell the market in this press conference that he aims to get rates to neutral? Would that be a big statement from him?
I think over time, yes, that's everybody's aim. But really, I think he would have to acknowledge the fact that there are a number of uncertainties still ahead. And I think he will still be flagging that inflation uncertainty, but then prioritise the labour market. And I think that will be the balance of the communication. I think what will be interesting is if we, in the minutes start to see, a much greater division within the Fed. That is likely, and that could then lead to further speculation in the markets in terms of the pricing. So I think that's where we could start to see some market volatility further down the line and in speeches.
And so sticking to central banks this week, we also hear from the Bank of England.
Yes.
No rate change expected by markets, but a lot of conversation about QT, perhaps. And we have an interesting story quoting Sushil Wadhwani, who was at the MPC almost 20 years ago now. But he's talking about how transmission has been damaged by QT and they need to be doing less of it. And obviously they're doing it at a loss for the Treasury. So how are you expecting that conversation to unfold?
Well, I think they've got to balance this, the impact on the bond market functioning and the transmission, and as well as locking in losses as well. So we are expecting, along with a lot of market participants, we are expecting to scale back from £100 billion to say 70 to 75 billion range. Yep. So expecting that pullback. But, they can still have QT with, just the natural roll-off of roll-off of existing debt. Yeah. So that passive component will remain. It's just that active component is starting to look a bit, as you say, difficult for the Chancellor going forward. So it's there is a tricky time for the.
There's a great
market.
number of economists, and we've got a story on it this morning, which is there for everybody to read, that says there's a great number of economists that expect no more cuts from the Bank of England.
From the Bank of England. Well, I think. if you look at the data, I mean, the data this morning, we can see that we're still seeing wage growth decreasing. You know, inflation is elevated, but there's still room to cut, but at that quarterly cadence. So we have, there is a possibility of another cut this year, possibly in November. But you know, we need to keep an eye on the data.
Are you moving away from that cut, or are you kind of as you were on that cut? Is the arithmetic changing?
I think there's a lot of uncertainty. I think the budget, the timing of the budget, we are going to see some fiscal constraint filtering through, and that's going to be a squeeze on the economy. But the timing of the budget and the next cut, I think that could be a bit of an unknown there. It's just too many moving parts. So you could see a hold in November, but at the moment there's still enough to justify a 25 basis point cut. And we were expecting originally, if it wasn't for the timing of the budget, we were expecting 25 each quarter. And I think, you know, that the magnitude of those cuts will probably continue. But it's
You're saying a cut is justified. Are you looking at the labor market or progress on inflation to make that call?
I think it's our expectations that wage growth will continue to decelerate as we're seeing. We've seen that trend over the over the first half of the year, and then we are expecting this fiscal constraint to come through. The growth recently has been flat. It's been, you know, the monthly numbers are volatile, but the activity data is starting to lose steam. So in that sense, with that combination, you would expect, you know, further cuts to very gradual pace to really be quite justified, yes.
And are you expecting any of this tech investment in the UK that Trump's bringing over to have effect on the UK economy in the near term?
I think that would be wonderful if once it's implemented and confirmed and implemented. But these things take a long time to filter through into the economy. These are long-term investments that can raise productivity and improve potential growth. But this comes over multiple years, so it's not something that's going to save the Chancellor immediately, unfortunately.
OK, just to complete our trip around the world in central banking terms, let me ask you about the BOJ. Again, nothing expected, no change in rates expected for a little while there. How much has the change of Prime Minister pushed out the next hike for the BOJ?
I think there are a number of uncertainties that I've been flagging through the year, actually. So tariffs was the main one. But then, obviously, with the change in leadership, that is another factor that I think justifies waiting until January. So I know that there are some investors who are looking for October, but I think it's going to be very difficult because you have the leadership challenge, vote is on October the 4th, and the candidates, if you look at the runners-up of the last leadership election, LDP election, those two candidates are very, very different, and they are both going to run this time. So Takaichi would be the first female prime minister, a first female leader of the LDP, but her, you know, she does favour further fiscal easing. She has, in the past, she's been quite dovish with regards to monetary policy. She hasn't said anything in that light recently, so we'll have to wait and see what her views are. But then if it's Koizumi, who was the third runner-up, he was more business as usual, very similar to Ishiba, but possibly a more popular face for the party. But again, I still think that January is more likely. And if not, we could see it. If I was going to change my call, I would push it out further.
OK, Sri, thank you very much. Sri Kochikavindan, Senior Research Economist for Aberdeen. So this week, we keep our eyes firmly on the Fed, of course, and the Bank of England. But also President Trump's visit to the UK will be catching our attention. So much more on that still to come. President Trump is set to unveil over $10 billion of economic deals as he arrives for his state visit in the UK. We'll discuss what that means for UK business. Siobhan Haviland joins us, Director General of the BCC, the British Chambers of Commerce. That is next. This is Bloomberg. Welcome back to the opening trade, 30 minutes from the start of equities trading. So let's look at the futures picture this morning. Tuesday, the 16th of September, and there doesn't seem to be any reason to go anywhere very quickly on European futures. A lot of things to wait for this week. We're waiting, of course, for a host of central bank meetings and decisions. First amongst those, and of most importance, is going to be the Fed decision. That comes tomorrow evening, European time. And so certainly, Valerie, that's where the market's focus is going to be. And in the meantime, futures are flat to positive.
Yeah, let's take a look at how European fixed income is opening up. We are seeing a little bit of a weakness underperforming treasuries so far, just by 1 basis point. German 10-year yield is higher, undoing some of yesterday's rally. But remember, we still have got a lot of risk events on the horizon. We do have the German ZEW survey coming out later this morning for a possible catalyst for the European market.
Catalysts. Let's talk about catalysts. I thought the Fed would be the biggest catalyst this week. I'm beginning to wonder whether that is the case. We're going to have a phone call between President Trump and China's Xi Jinping, we think Friday. This after officials meeting in Madrid reached a framework deal keeping the TikTok app running in the United States.
We had a very good meeting with China. I was surprised. I didn't expect it to that extent. And I'm going to speak again with President Xi on Friday. And, I think that'll confirm things up.
Alan Wong, our China economy and government editor, joins us now from Hong Kong. Alan, how significant is this Trump-Xi meeting? What could be decided? Is it just TikTok, or are there going to be other things on the agenda? How big a volatility event could it be?
It does sound like the talks that they've had between the U.S. and Chinese negotiators in Madrid this week, starting Sunday, was mostly about TikTok as one of the most tangible outcomes. But they also talked about other affairs. But judging from how the U.S. side framed the upcoming phone call and what Trump just said, it looks like that TikTok will be the main thing. But we also know from Trump that he is ultimately aiming to reach a big deal with China. And whether they could announce more than just some agreement on the future of the U.S. operation of that social media company remains to be seen.
Alan, what expectations do we have that we get a wider, bigger trade announcement? Maybe not this week, but soon. I know there's a deadline in November to come back to this topic and to readdress it, these two countries, to avoid an escalation in tariffs. How certain are we that we get some progress on that front?
I think the coming Friday phone call will be a very good checkpoint to help us see whether the U.S.-China relations are, as a whole, improving and whether they'll pave the way for something even bigger. The next checkpoint after that would be a possible meeting between President Xi and President Trump in South Korea on the sideline of the APEC meeting. We usually can tell whether the meeting or whether the engagement is successful even before the meeting itself, because the officials from the two countries will meet and they'll talk about tangible outcomes for that meeting, so that when the leaders do get together, they have something that they can announce. And just with the case this Friday, before Trump and Xi will talk on the phone, the negotiation of both countries, they got together, and then it turns out that they could reach some sort of a consensus on TikTok. But I think it's important to note that we don't have details of what that framework they agreed to looks like. And there are important questions such as who's going to own this U.S. operation of TikTok, and whether the core technology of TikTok is going to be controlled by China or be sold to the U.S. and under what terms. Those are some of the uncertainties that we still haven't figured out yet.
Alan, thank you very much. Alan Wong, our China economy and government editor in Hong Kong. Let us move on to other matters. The US delegation is now making its way from those talks with China in Madrid to the UK. Bloomberg understands that President Trump will announce economic deals worth more than $10 billion during his state visit. It comes as Prime Minister Keir Starmer faces pressure to boost investment at home. Joining us now, Siobhan Haviland, Director General of the British Chambers of Commerce. Let's start with the simple question then, Siobhan, of what it is your members want to see from this kind of state visit by President Trump.
Good morning. I think our members will be very pleased to see that business is leading the way in this state visit, that investment is front and centre. Clearly, AI, our digital revolution, is core. Our members are using that more and more. Last year, 30-odd% said they were. It's now over 50%. So it's great to see investment in AI, in nuclear, we saw yesterday, and other financial services investments. I think it's a great vote of confidence in UK PLC, which, of course, our members know is a great country to invest in. So we'll be very pleased, and it's really good for business confidence.
Good for business confidence. What about addressing some of the things that have not been bottomed out and resolved from that trade deal between the US and the UK? There doesn't seem, from our reporting, there doesn't seem to be an expectation that steel gets addressed, that whiskey gets an exemption, that all of those other sectors that are still in limbo find any kind of certainty. Will that be a disappointment?
It's really important that trade is on the agenda. As you know, we came to an arrangement, a first country in the world, earlier this year. That deal hasn't yet fully been put in place. So we want to absolutely see that happen. And of course, there are other negotiations going on. It's really important for steel and aluminium that we bring that 25% tariff down. Of course, everyone else is still facing 10% tariffs, whereas before, earlier in the year, before the administration came in, we were all at 0%. So it's really important that trade is part of this discussion. The US is our second biggest trading partner after the EU. It's 300 billion of bilateral trade across our countries. So we would really want to see that as part of the discussions and the negotiations.
Siobhan, can you just put some perspective on this for us? The $10 billion that was announced that's going to be invested into AI, a lot of that going into data center infrastructure. Is that a good amount for the UK, or were you hoping for more?
I think it's a great start. I mean, you've seen US tech businesses investing in the UK for years, right? So they're investing more and more. And once they started, they've kept going. And that just shows what a great place the UK to invest in is. What's really important is that this investment covers all parts of the country. So we expect to see announcements of data centre investment in the northeast. Yesterday we saw nuclear investment from Hartlepool to Nottingham to Essex. And these investments aren't just about those specific items being invested in those places. Remember, of course, it's also about the knock-on effects, supply chains, local economic impact, which is really positive both on jobs and supply chains. So, 10 billion is a great number. We've seen possible investment numbers much bigger than that over the next 10 years. But all round, the point here is that this investment shows what a great place the UK is to invest in. We have a really strong environment. We need to keep focus on that tax, regulatory environment. But it's a real vote of confidence in the UK.
Siobhan, you mentioned that regional disparity is important when it comes to this investment that's spread out across the UK. Are there any other things that come to your mind that are important for the BCC to communicate to these business leaders that are in town from the US?
Yeah, I mean, we would say it's a really fantastic place to invest. We have all the right fundamentals. I have the joy, of course, traveling the country and meeting the businesses of the UK week in and week out. And they are entrepreneurial, can-do business people. We are always open for a deal. We have great places, across the entire UK to invest in, real strong fundamentals, investing in energy. We've got planning reform now, energy diversification, and incredibly skilled people. So, we are an open global trading nation, and we would say, come and work here, come and join us.
Siobhan, good morning, it's Guy. Do you think any of the deregulatory, business-friendly approach taken by the Trump administration, taken by the Treasury Secretary Scott Bessent, will rub off on our Chancellor Rachel Reeves when they meet a little bit later on today?
To be honest with you, having worked with this government now for a year, and in fact before they came in, they always and often talk about regulation. So they are absolutely in the market for finding regulation that isn't working for our businesses and working out how they can fix that.
Yep.
So I would say that this government's already been sort of on the record of saying, let's find regulation that doesn't work, like the planning reforms that they're putting in place, and make sure we make it easier for business. Clearly, we've had a tax increase from the Chancellor in the last budget.
Yep.
It's been hard for business. It has been. And confidence is still fragile, really. It's going to be really important for her to, back business in the next budget. But I would say on regulation, they're doing the right things and they're listening.
OK, but as you say, maybe not that business-friendly. Do you think the UK government could be more like the US administration, more like the Trump administration? We think about the big, beautiful bill. We think about how they are trying to change the narrative in the United States. There's an expectation around quarterly reporting. Like, what do you think about that? Do you think British businesses should be reporting quarterly? The US administration seems to be making quite big changes at the moment. How many of those do you think would work in the UK? And specifically on quarterly reporting, do you think it's a good idea? Do you think half-year reporting would be enough?
I think our businesses would say that there are enough demands on their time outside running their business, and that more reporting might not be the right way to go, that we are pretty transparent and open as businesses already. I think that I think that we're probably in the right space in terms of regulation. We always have to keep an eye on it. But what we want to see from the Chancellor this time round in the budget is keeping costs down for business, right? Businesses are struggling under a lot of costs. They want to see costs kept down because they're not investing. They're not investing enough because they're holding on.
Do you think that moving to, if we didn't have to report, if our companies didn't have to report every quarter, that would reduce costs? I'm assuming you would support that, anything that reduces costs. Do you think reporting every half year would be a good idea? That would have a significant impact on the cost of running a business in the UK, a big business in the UK.
I think anything that takes the burden off business in terms of costs, in generally is a good thing, without sort of, we don't want a bonfire of regulation. That's not right. We need a very clear, stable regulatory environment. We don't want chopping and changing all the time. It's hard enough for business as it is. So let's just make sure it's the right amount of regulation. It's the right amount of reporting, and we're not changing our minds all the time.
All right, Siobhan Haviland, thanks for joining us with your thoughts on Donald Trump's recent visit, or upcoming visit to the UK, the Director General of the British Chambers of Commerce. Coming up, Italian banks in focus after the government is said to be drafting a plan to raise an extra 1.5 billion euros from lenders. We'll talk about that and your other stocks to watch next. This is Bloomberg.
I think you always have the comparison between different points in time, and they're more balanced now. And personally, I think they are quite balanced in terms of upward and downward potential of inflation.
That was the ECB Governing Council member Martin Kutcher speaking to our colleague Lizzie Burden just in the last 24 hours or so. 7:46 here in London. Joining us now to talk about these markets in 3 minutes, our Markets Live executive editor Mark Cudmore. Mark, let's find out what's top of mind for you. We're working towards a Fed meeting, of course. Markets seem pretty peaceful with that still on the horizon, but you're spotting some dollar softness that you're putting down to the Miran story. Are we back to talking about steepness and dollar softness on the back of that then?
We very much are talking about that. I think one of the problems going into this week's Fed meeting, which is what everyone is eyeing, is that the trades have already played out. We've pre-priced this Fed very aggressively, both from the bond side and the stock side. I think the narrative is now clear, and it's that, with the administration pressure, with the appointment of Stephen Miran, with the fact that they're trying to fire Cook, that we're going to get more dovish monetary policy than orthodox economics would suggest, and that's a narrative likely to run. So but markets are already pricing that in via a sharp collapse in yields and through very bullish stock market, which makes the risk reward of playing it further post the Fed much more difficult. No reason to go against it, but there's a risk of that kind of little buy the rumor, sell the fact event. The one theme that's probably got a little bit more sustainability is dollar weakness. That's the one trade that's had very little kind of correction all year. It's been a very safe trade to play, and whatever the administration is doing, it's undermining US institutional credibility, and that is bad for the dollar.
Mark, what are your thoughts on emerging markets then? That sounds like a pretty, I guess the scenario you laid out sounds like a pretty decent trajectory for emerging markets to outperform. Is that your case?
Absolutely. So the dynamic is we're getting easy monetary policy. We're getting a bullish environment for stocks. Basically, what the Fed is doing, what the administration is forcing the Fed to do, is to juice markets in the short term to create longer-term risks. But they're still being juiced in the short term, which is why you don't want to fight it. And we're also getting an easing of the dollar, which is an easing of financial conditions to the rest of the world. It is a great environment for emerging markets. We're seeing that dynamic play out. Emerging markets have been doing wonderfully all year. They've been outperforming the US, and I expect that to be a theme to continue. And really important to emphasize, this is not just about China outperformance, which has happened. It's about global EM generally. There's a little bit more idiosyncratic stories, but many countries around the world are really outperforming the US.
Mark, if the White House is successful in its takeover of the FOMC, are we going to see more creative ways of managing the long end of the curve?
I think absolutely. I know that some administration officials have previously been very critical of things like QE and suggested that there shouldn't be such interventions. But they've also made more clear that they want long end yields lower, and they've also kind of shown a sympathy with the idea that the ends justify the means. So I expect that next year topics like yield curve control, maybe even QE, may come back onto the radar in a very serious way. So I think that's why the yield curve will be very hard to play. I think they'll try to get 10-year yields lower. 30-year yields may still go higher, though.
All right. QE on the radar for Mark Cudmore, Bloomberg's Markets Live executive editor. Mark Cudmore, thanks for joining us with your thoughts on the market. And remember, you can get up-to-date analysis and insight from Mark and the rest of his team. Just type MLIV GO on your terminal. Now let's get our stocks to watch ahead of the European Equity Open with Chloe Melly. Chloe?
Good morning, Valerie. Let's start by keeping an eye on Italian banks today, as the Italian government is said to be drafting plans to postpone tax deductions for that sector. This is essentially an extension of a measure that was taken for 2025 and 2026, and it would help potentially raise 1.5 billion euros from banks in 2027. So we should keep an eye on some of those key names in the Italian banking sector. Unicredit, of course, Intesa, Banco BPM, and also Monte Paschi, which is also busy with that Mediobanca takeover. They've obviously all been doing really well over the last few months. So let's see how the market reacts to the tax news. Moving on to Kering in the luxury sector, the owner of Gucci. It was the victim of a cyber attack. It said that hackers had accessed some customer data, but no financial information was taken. So this could lead to a bit of weakness in what has otherwise been a really good recovery in the shares. Of course, memories of what happened with Marks and Spencer's springs to mind, the paralyzing of the operations. So that might make analysts a little bit colder on the stock. It's already not an analyst favorite. We can see only 6 buys and a large majority of holds and sells for Kering. So let's keep an eye on that today. And finally, let's talk about the European budget airline sector. So JP Morgan has got a new note on that sector, saying it is cautious on those companies, and also singled out EasyJet in particular, cut the rating to a neutral rating. It's already been underperforming its peers, so it's going to be likely a little bit weaker at the open this morning. The analyst said that the capacity growth in that sector meant that the supply was outstripping demand for some destinations, which is obviously not great for that pricing growth. So let's keep an eye on that sector as well this morning.
Chloe, thank you very much. Chloe Melly with the latest on those stocks that we will keep in focus. Back to something that we were just discussing a moment ago in a sort of European context, but really interesting to watch the SEC, the Securities Exchange Commission over in the United States, talking about making a priority of something that President Trump has called for, and that is moving away from quarterly reporting towards half-yearly reporting. It's interesting because I feel like this has come up before, even amongst certainly amongst business leaders. I think certain Davos platforms, business roundtables, have called in the past to make this happen, because obviously lots of businesses don't like all of the structure and the cost that goes along with quarterly reporting.
And it was something that Trump pushed for back in 2018, but back then it was all more about deregulation and helping companies IPO. The SEC with their quarterly reporting burden, that's one big headache for a company who is looking to IPO to get those filings done.
Is this market positive? Would that be good news? Would that take costs out for companies, and therefore actually this is market positive, or is it market negative because investors don't have the same information and visibility they have on what is happening I don't know.
One of the points made in our story by one portfolio manager is it's just markets volatile because his particular view is if you hear from companies less frequently, there's more opportunity for volatility.
But you'd have to think that if a company took that view that would be negative for their stock price, they would go ahead and voluntarily still report quarterly. So there is some give and take on that platform. If they think that's what their investor needs, then they'll continue with it.
But in aggregate, if companies are reporting, those reporting moments become more significant and therefore potentially more volatile because the updates become more significant just by their very nature.
Yeah, and I suppose you still have rules around, if the outlook materially changes, you have to update investors. So to your point, Valerie, might there just be more ad hoc announcements from companies as
which
6
again
months
would increase volatility?
Yes, because 6 months is quite a long time, isn't it, in between hearings?
Possibly more useful to have trading updates rather than these massive earnings revisions and earnings reports all at once, no?
Sure. Yeah. I can't figure out if it's market positive or negative. In some ways, you could argue the more I know, the better decisions I can make. But on the other hand, you could argue that companies have a huge overhead. The cost of running a quarterly reporting session is enormous. And therefore, is that more positive for a company?
And I think Trump isn't just focusing on the regulatory burden, but he just wants companies able to take more of a long-term view. And it's easier to do that if you don't have to face investors, with your balance sheet every 3 months.
But if you have to update on material changes, maybe that doesn't change that much.
Yeah, but maybe your point is
it would
they
end
just
our
do
excitement every 3 months.
Well, precisely.
Maybe they'll just do trading updates for our benefit, Valerie. Maybe that would be good. And President Trump cited China, didn't he, as a place he's taking inspiration from, which was an interesting dynamic. There are places in Europe where you don't have to report every quarter, so maybe that's another area of inspiration. Right, coming up, we'll bring you that opening trade. European futures not pointing toward a huge amount of action this morning. We're waiting for the Fed, of course, a little bit later on this week. Starts today, finishes tomorrow. Tomorrow evening, European time, we get the answer to the question from the Fed. This is Bloomberg.
Tuesday the 16th, good morning. Let's talk about Monday the 15th and talk about the impact that it's going to have on today's session here in Europe. Futures are not pointing us in a clear direction this morning. So we went out here. US markets rallied into the close. You had a bit of a TikTok story, oracles of facts that we need to throw into the mix as well this morning. It looks like it's going to have a positive reaction to the TikTok news. So just think about that. But kind of Monday felt like a bit of a non-event. We're waiting for Tuesday. It's retail sales day. The Fed meeting starts. We're going to get the results, obviously, tomorrow of that Fed meeting. The countdown really is upon us, which is why I think Europe, Val, is starting kind of cautiously.
Well, equity markets across Europe are flat to the upside. We are green across the board, but really not by much. Euro Stoxx 50 futures up less than 0.1%. It was a very strong day for Euro Stoxx 50 yesterday, though. FTSE 100 futures also up by less than 0.1%. Donald Trump does land here in the UK later this evening to kick off that state visit, possibly a catalyst for the UK markets. And DAX futures just hovering on to the green.
Yeah, well, we'll certainly watch, Valerie, I'll pick up. We'll certainly watch all of the developments around Trump's visit to the UK. Thinking about things that could be on the move in the short term, then, Valerie, we're certainly focused on some financial services names this morning. BNP Paribas raising its key return and capital targets. The CEO over at BNP overhauling the French lender's domestic network ahead of a new strategic plan, so we'll keep an eye on that. The Italian banking sector in focus. Meloni's government is working on a plan to raise an extra €1.5 billion from Italian lenders. This would be by postponing their tax deductions, so we'll continue to watch that sector. We often get news flow surrounding thinking there. And JP Morgan turning more cautious on the European short-haul airline sector, so we'll watch airlines, including EasyJet, at the open guide.
We certainly will. We'll keep an eye on all of that. I'm going to throw into the mix what is happening with Kering right now. Keep an eye on UBS. There's plenty of other stock stories that we need to be focused on as well. The tech read across from the United States is going to be interesting. The FTSE 100 out of the gates with a mild negative first print. We are down less than 0.1%. We'll see what else happens across Europe. We're expecting a very flat, very cautious start. There's a lot of major risk events about to emerge for the market to digest. Retail sales is going to be one of those big ones out of the United States. Then, of course, we get to the Fed meeting, which is going to be resolved tomorrow. Got Trump here. What's going to happen Thursday? I think that's going to be interesting for Keir Starmer. Friday, obviously, we've got to factor in this call between Trump and Xi. There's a lot of things coming up. So the market taking a very cautious approach this morning. The Stock 600 is up by less than 0.1%. The IBEX is absolutely flat. The CAC 40 is mildly negative. The FTSE 100 is barely budging. We await in anticipation of these key events, and that is when the trades may kick in, but not yet. That certainly seems to be the narrative, Val.
Well, when it comes to the sector's picture, it looks like we've got 12 in the green to start the first moments of trade. The remaining 8 in the red. At the top of the basket is basic resources, auto parts, technology also at the top of the basket. And this is interesting because tech really did outperform yesterday, SML being one of the biggest drags to the upside. That looks like that tech trade is continuing today. At the bottom of the basket, you have things like insurance, telecom. I also want to note that when it comes to single names, we have EasyJet down over 2.5%. That weighing on the airline sector. That's after, as you mentioned, Anna, JP Morgan said they were cautious on the short-haul flight industry here in Europe.
Yes. Let me just weigh in on a couple of names that are on the move this morning. So starting with the basic resources sector, you mentioned this, Valerie, that's doing pretty well. There's some gold miners in the mix there, and we should mention that gold touched another new high, didn't it? So Fresnio is doing well on the back of that one. And then the auto parts sector doing okay. Yep. And I noticed that Ferrari has a new buy at Berenberg. So, another day where things are kind of quiet and some of these ratings changes are cutting through.
I think there's a note out on some of the gold miners this morning, so that may also be lifting some of those names as well. In terms of the downside, it's interesting. So L'Oreal and Unilever and Haleon are all soft this morning in the consumer side. The pharma space is once again soft as well. It was a story yesterday, so just bear that in mind too. There doesn't seem to be a kind of clear sense of direction here, though, coming out of Europe. ASML is the top gainer. Tech seems to be performing reasonably well. Ferrari's up on a note. Rheinmetall is trading a little bit sort of softer, a little bit firmer as well this morning. But I'm struggling to see an obvious kind of narrative outside of broker notes having an impact on some of the single names.
Yeah, that's it then. Just waiting for the Fed. Is it Wednesday yet? Is it Thursday morning yet, in fact?
Waiting for the Fed, that decision coming out on Wednesday evening. Joining us now to discuss central banks and markets is Bilal Hafiz, Macro Hive CEO. Thanks for joining us this morning. And I hear you're calling for a 50 from the Federal Reserve.
Yes, we are. I mean, it's going to be a very close call. So we're saying like a 52% chance of a 50, but we're leaning towards 50. And the reason for that is that there's been a clear deterioration in the labour market. We've had the benchmark revision, which show much slower payroll growth. We've had negative payroll prints now, if you look at the private sector after the revisions, and wage growth has been slowing as well. So taking that all together, we think 50 would be our base case for Wednesday.
Do you think that would come alongside Powell showing some urgency on wanting to get to neutral, even below neutral? How would he frame this in the press conference?
Yeah, it's a good question. I mean, the way it would get framed would see a change in the dots for next year, and he probably would talk more about trying to move policy from restrictive to neutral. He's always reluctant to talk about what the level of neutral is. He tries to stay away from discussions of R-star and so on. But I think the narrative will start to shift from we're moving from restrictive and we want to move to neutral. I think that will be the rhetorical shift.
I mean, Bill, doesn't 50 smack of an emergency and some sort of panic, or does it not anymore? I mean, we had a 50 last year, didn't we?
Yeah, we had a 50 last year, and some significant figures at the Fed, like Waller, he called for an easing earlier a couple of months ago. So, while it could sound like, it will certainly be unexpected, but I think there'll be a good rationale for it. And whether the market views it as an emergency or not is up to the market, but I think there's enough of a case that it could be justified.
Okay, and what market impact would that have? Continue to weigh on the dollar? I know you've been quite negative on the dollar for some time, and you would expect that to continue then on the back of
absolutely. So I think this would help spur broader dollar weakness. In recent months we've seen more moderation in the dollar weakness story. I think that will sort of expand.
Do you think that gets talked about in the Fed meeting? I mean, with Miran around the table and.
Well, I mean, I don't think they'll talk about it so much at the.
He might
Fed.
try.
Yeah, he may try and talk about this as a sort of longer-term story of them trying to sort of bring about change in the trade balance and so on. But I think for now, if you look at Miran's stance, it would be there's a deterioration in the labour market. People's fears about the tariffs are overdone. Mirrors often talk about the tariff derangement syndrome that everyone sort of faces, and so he'll argue that inflation's not the problem, labour market's weakening, and so we have to cut rates.
Is this sort of sideshow compared to the fact that we are seeing the White House trying to take the Fed over? How seriously do we take that? The boss of the Council of Economic Advisors is going to have a chair at the FOMC today.
I mean, I think this is an important and big shift, that we're seeing in the Fed. I think already it's had an influence on the Fed. We have a model, an AI model that interprets the hawkish dovishness of Fed statements. And since Trump increases rhetoric against the Fed, they became much more dovish since then,
right?
Separate to the data. So it's already having an impact on the Fed stance.
Is this an economy that, therefore, we could expect to be run hot? Is that something we should take seriously? That you run the economy hot, you accept the inflation, you get the nominal growth, you deal with the debt. How far does this go?
Yeah, we'll have to see. I mean, the one thing we have to remember is, in the end, while Trump and the administration can have an influence on the Fed, the Fed, even with appointees from Trump, will still have a lot of leeway in terms of how they implement policy. The Fed's probably the most independent it can be of any agency that exists within the US. So that means that they'll try to run as hot as possible, but they will keep an eye on things like inflation expectations and those sorts of factors, which at the moment are fairly well anchored. So at the moment, at least, that doesn't suggest that the market is viewing it as a loss of credibility by the Fed.
Bilal, do you think that the Fed has to be reinvented?
It's a good question. I think all central banks need to be reinvented to some extent across the world. What we saw after COVID was that they were too late to hike. That was one issue. Another issue is all central bank balance sheets, the Fed and others, are way too big, so that there's an issue around all of that. And then also, if you look at, say, the Fed, they changed their framework just as inflation took out by introducing FATE. So that tells you the timing of their framework was wrong. So that tells you there is a need for reform. The question is what those reforms should be. For me, dealing with the size of the balance sheet is a big fundamental issue for all central banks around the world, and that the relationship between the balance sheet and the fiscal side is probably going to be the big story for years to come.
In that manner, do you think that central banks should have the power to undertake quantitative easing?
I think that it should be heavily curtailed, especially if you're in an environment where fiscal deficits are running much larger, because otherwise you run into the risk of fiscal dominance where, the monetary authority and the fiscal authority start to merge together.
Should Treasury have control of that? QE?
Well,
because that's an argument that's being made.
Yeah. I mean, the Treasury can... they can set up an account to buy treasuries back. They can do buybacks, certainly, but they can't necessarily print money. So what we're saying there then is, should the Treasury take control of the central bank balance sheet? And I think that's not the appropriate action to take.
And in a UK context, Bilal, because of course the losses that the Bank of England makes on QT feed through to the UK Treasury. So how should that conversation? How should that conversation develop, do you think?
Yeah, absolutely. And I think that is one mechanism to curtail the influence of the Treasury on the central bank, because they have to take the losses. So they should continue to have that loss that goes to the Treasury. In the case of the Bank of England, the question now is that will they be reducing their quantitative tightening that they're engaging in or not? And given the fiscal issues, there could be some political influence here in the UK even, where they start to slow that down in order to stabilise the gilt market.
So we talked a lot about the way that politics perhaps combines with central banking. I want to ask you about AI and technology and how that feeds into central banking as well, because I know you've thought a lot about AI. And do you see this as maybe inflationary in the short term, deflationary in the medium term? How should market participants, broadly defined, think about AI from that macro landscape?
Yeah, from a macro landscape, I mean, simply put, AI in general should be productivity enhancing, in which case it should be deflationary or disinflationary in the long run. In the short run, the clearest manifestation of AI is a massive capex boom that we're seeing in the US. So in the first half of this year, there was probably as much capex in AI than there was consumption, which is just quite phenomenal, probably one of the largest private sector capex booms we've ever seen. And so far, that hasn't really been that inflationary. So that tells you that even in the short run, with a demand boom going on, because there's more capex than consumer, it's less inflationary overall.
But you make the point that there could be, inflation in energy prices as a result of this?
So for me, the ultimate constraint for AI is not so much chips, data centers, it's power. And I think that will eventually be the inflationary driver, where there will be a shortage of power in the US, electricity and so on, and electricity prices will start to, rocket higher, and that will ultimately be the inflationary sort of dynamic for AI into the broader economy.
When does it start to meaningfully enhance productivity? When do we start to see the companies that are investing all this money start generating a meaningful return on this investment? How far out is that? Because at the moment there's a lot of hope in a very narrow portion of the market, which is enhancing everybody's risk, and this is a stock market that rockets higher on tech, that we don't know when it's going to deliver.
Absolutely. It's unclear when we'll see the productivity sort of being delivered. I mean, if you look at the dot-com boom, we did see a jump in productivity in the latter half of the 1990s, but then in the 2000s, the productivity dropped thereafter, even though we had this big sort of dot-com boom. At the moment, at a sectoral level, the clearest jump in productivity you are seeing is in the tech sector itself, where essentially companies don't need as many programmers because people are just vibe coding, so to speak. So that's one area. Outside of that, it's unclear what the relationship is between AI and
when does it make money?
It's making money if you buy tech stocks right now.
Sure.
So that's where it is making money. In the case of use cases, at the moment, it's unclear what the exact use cases are outside of a hardware story. That building chips is probably where you do make money right now.
Okay. Does that worry you?
Of course it worries me, but you know, the clear thing right now, I would say, is that the demand for AI is just off the charts. You know, there's no sign of that slowing down. So
demand, pay for demand, that's a slightly different thing. Anyway, Bilal, I'm being told I have to stop now. Carry on with this conversation all day. Bilal Hafiz, Macro Hive CEO, thank you very much indeed. Call 6 looks like this. There are actually a few names out there that have been being moved around by broker notes this morning, so just be aware of that. But you do have the pharma space catching a bid once again. Tech looks like it is leading the charge, as you can see. What is interesting is a company associated with that data center story, Schneider, under a little bit of pressure today. Let's talk about some of the other moves that we're watching. Here's Chloe Melly.
Good morning, guys. So a little bit of weakness across Italian banks this morning as the Italian government is drafting plans to postpone tax deductions for that sector to raise an extra 1.5 billion euros. So we can see a bit of weakness. The weakest one is Monte Paschi. Banco BPM is actually doing quite all right, but a little bit of weakness on the back of that tax news this morning. Moving on to Ferrari. Ferrari was rated a new buy at Berenberg and also raised to outperform at Mediobanca. Berenberg analysts said that it was a really compelling long-term investment, and it noted the loyalty of the extreme loyalty, actually, of its customer base. So the shares are moving up on that. We're up now almost 2.5% on the back of that. Moving on to EasyJet, which was cut to a neutral rating at JP Morgan. JP Morgan noted that the extra capacity growth meant that there was too much supply and too little demand, and that really impacted pricing. So on the back of this downgrade, EasyJet is down this morning. We're down 2.6%. Moving on to the beauty sector, L'Oreal and Beiersdorf are also down this morning. They were both cut to underperform and hold at Jefferies. Jefferies noted that the growth there was normalizing and that injectables and weight loss drug actually could potentially hurt that beauty sector a little bit. So they are down on the back of that. L'Oreal especially down 2%. And finally, Trustpilot, the customer review company, had really good earnings this morning. It raised its adjusted EBITDA target, and it said that AI was really pushing that business forward, and therefore it is up 8.7% this morning. It was up more than 15% earlier, but it do really good investor review for Trustpilot this morning.
OK, thank you very much, Chloe. Chloe Melly with the latest on those equity movers. Coming up, we'll talk about one stock that is moving a little this morning, down by 0.7%, and that is UBS. Shares a little weaker this morning after lawmakers voted against delaying stricter bank capital quality rules. We'll discuss what it means for the banking giant, what options the banking business has. That's next. This is Bloomberg.
Welcome back. A little softening, I would say, in the European picture this morning. We've gone from flat to negative over the last 17 minutes. Started off fairly flat, maybe pricing in some of what we saw yesterday in the United States. That has now unwound, and we are starting to soften. We're near session lows. The FTSE 100 is down by 0.2%, the CAC down by 0.4%, the DAX is down by 0.4%, the IBEX is actually down by 0.6%. So some quite significant. There is some weakening in terms of share prices that we are watching this morning. Quick look at some of the stocks that are standing out. Let's take a quick look and see what is happening with UBS right now. It is down pretty much in line with the market, I would argue. in terms of what we're seeing. A little bit of softening maybe coming through, but the Swiss market is down by 0.3%. So UBS is softening a little bit more than that, but not by much. This comes, of course, after Swiss lawmakers voted against the second attempt to delay strict bank capital quality rules in Switzerland, which will lift UBS's capital requirement by some $3 billion. We're joined now by Miran Fed, our Swiss finance reporter in Zurich. What are the likely options now being considered as a result of this vote by the management at UBS?
So we're looking at a wide range, actually, from just minor tweaks, like just potentially doing SRTs, which is an instrument that a lot of banks are using at the moment, or the bank could be looking at just downsizing or spinning out its investment bank. That is something that UBS had already done, downsizing the IB under Emotti in 2008 after the financial crisis. And that's something that also Credit Suisse was looking at doing in the run-up to its collapse. We're also looking at potentially doing upstreaming. This is something that would help the bank over time reaching the 26 billion that the Swiss government is asking for, and just also remaining disciplined, pretty much just setting aside capital each quarter and reaching that amount, because it will take 6 to 8 years, roughly, for the implementation period. So the bank has time to look at these options. So these are the kind of minor tweaks, but we're also looking at more sort of tectonic measures, such as relocating the HQ, which is something we had reported a couple of months ago. And this could be something that the bank could do via M&A, just to kind of shift the problem to another location and kind of going around the Swiss government's regulatory hurdle.
Miriam, how are those changes being received in Switzerland? The fact that UBS is floating, possibly leaving Switzerland, is that something that is having any take-up by the business community as something they want to prevent?
Yes, this is something that would be dramatic, really, for the country. That would, for the Swiss government, rid them of a huge conundrum, obviously shifting it to another regulator. But for the Swiss economy, it would be completely disastrous. Bear in mind that now, with Credit Suisse gone, UBS is the last remaining global major bank in the country. And also, it is core to Switzerland's economy and identity, and it is also one of the major employer in the country. So it would have tremendous effect on the economy and on the general public as well.
And so what's the investor view here, Miriam? I mean, we can see the stock down a little today, but the wider market is a little weaker today. So what's the bigger picture investor view?
So it's sort of split. We have Sevian, the activist investor that has been quite vocal about being supportive or being of the view that UBS should relocate. And then there are other kind of quieter voices, but more numerous, that are kind of worried about the payout. UBS hasn't said anything about the next buyback program. They committed for this year. They're sticking to their plan, but there's a big question mark as to the buyback program and the payout for investors next year and the following years. And this is something that obviously is on investors' mind, and that UBS will have to sort of tread carefully there.
Miriam, thank you very much. Miran Fed joining us there, Bloomberg's Swiss finance reporter in Zurich. Let's talk about another business making headlines this morning, Verisure, which is an alarm and security systems company. It's said to be considering launching a €3 billion IPO in Stockholm as soon as this week. Let's get more with Pablo Mayo Quechero, who is Bloomberg's Europe Equity Capital Markets reporter and has this story for us. Pablo, good morning. So give us the details on this possible offering and how significant it could be.
Thank you so much for having me. Well, it could be the biggest IPO in Europe since Porsche's in 2022, according to our data. So sources have told us they could raise around €3 billion, largely in fresh capital that will be used to pay down debt. And obviously, it's a very exciting story for Europe after 3 years of muted IPO volumes. That's not to say that we haven't had some good IPOs in the last few years, but obviously having such a headline maker, so to speak, tap the market, that would be quite good for IPO momentum. So we're all kind of watching carefully and expecting the transaction to hit the screens over the coming days.
Pablo, how busy are we expecting this IPO window to be here in Europe?
Well, with a little bit of luck, it'll be one of the busiest we've seen in a while. There's at least a dozen companies, roughly, looking to go public in the current IPO window. That would be a major boost for Europe's IPO market. Now, having said that, the IPO market is by definition fickle and temperamental. So, something could happen tomorrow that could all of a sudden shut the window close. So we need to be careful and we need to account for that. But if all goes to plan, we could end the year on a high after what was a very slow first half of the year due to tariff-induced volatility.
In terms of kind of what is happening, just break it down for me, just segment it a little bit for me. What are we expecting next? Where are we seeing the most activity? Does that reflect anything about what is happening in individual countries, maybe around Europe?
Of course. I think arguably, well, let me start by saying that the pipeline is quite diverse. It spans across Europe, but you could argue that Stockholm, Frankfurt, Zurich, and maybe London will concentrate the bulk of the activity during this window. There's already 3 sizable IPOs in the market. You got Nova Bank in Sweden. It's a Scandinavian lender. In Zurich, you got Swiss Marketplace Group. It's a classifieds business. They're looking to raise around $1 billion. So it's a pretty sizable IPO. And then in Frankfurt, you got Ottobock, which is a maker of prosthetics and other type of medical equipment. So you got 3. You got Verisure, hopefully coming down the pipe. There's a bunch of others. There's even a couple in London. But obviously, you got a budget in the horizon, and it's TBD what's going to happen. But with a little bit of luck, we could end the year on a high.
Yep. Well, certainly it would be nice. Paolo, thank you very much indeed. The view from the IPO market. This comes back to the story we were discussing a little bit earlier about reporting, I think. Mm-hmm. Why would you want to become a listed company in this world where you can remain private for much longer?
Yeah,
and in some ways, the reporting story kind of in the United States, less reporting, less onerous reporting requirements, maybe encourages people to come to markets because the kind of the gap between public and private maybe narrows a little bit.
That was certainly the view I think Bilal was sharing with us, that was another lens to look at it through.
But then you come back to the UK, which doesn't have this requirement and yet struggles with IPOs.
Yes, other things at play.
Currency risk being one of them, many other things.
There's plenty of other factors. Talking of risks in the UK, we turn our attention to Donald Trump's state visit. We'll be discussing the implications of that next with Peter Westmacott. This is Bloomberg.
This is the opening trade. We're 30 minutes in today's European cash equity session, and it's increasingly looking a bit sour. We did start off with equity futures at least looking positive this morning, and that's now flipped clearly into the red. The Euro Stoxx 600 is down 0.25%. The underperformer being the DAX, down near 0.4%. FTSE 100 also in the red as Trump prepares his state visit, landing tonight in the UK. Guy?
Big picture, 2-to-1 down versus up, 390 down, 192 up. That's what the internals look like right now. We've slightly changed the metrics around what is happening with the volume. We've gone for the 20-day average to give us a better picture. And actually, for the first time in a very long time, we're actually starting to see volume ticking up a little bit. So we're up 18% versus what we've seen over the last 20 days. This is we obviously enter a crucial period for these markets. We're analysing what is happening with the Fed into that meeting. It starts later today. We're watching it very carefully. 52-week highs highs. We've also got some lows as well, which is worth paying attention to. Rheinmetall in the defence space, new high for that stock. Antofagasta in the copper space, up nicely as well. The gold trade seems to be on as well. There's some upgrades for names like Fresnillo this morning. And Banco BPM up by 0.3%. So that's interesting as well. The banking story front and centre. There are some downgrades, though. No, there are some areas that we're seeing some weakness this morning. And actually, it's kind of slightly related to kind of consumer healthcare. Haleon is down by 2.64%. Beiersdorf, maker of Nivea, down by 1.4%. Alcon in the eyewear space down by 1.23%. So that space under quite a little bit of pressure this morning, Anna.
Let's get into some of the other stories that we're following this morning, and we'll start with developments at the Fed then, Guy. An appeals court has blocked US President Donald Trump from firing Lisa Cook. The 2-to-1 ruling came just hours before the start of the Fed's meeting to vote on rates. This while Trump's ally, Stephen Miran, has been confirmed as a Fed governor by the Senate. The SEC says it's prioritising a proposal by Donald Trump to change company reporting in the US to once every 6 months from the current quarterly results. The Securities and Exchange Commission, the SEC, says it's pursuing a proposal to further eliminate unnecessary regulatory burdens on companies. And Google says it will invest £5 billion in the UK over the next 2 years to help meet growing AI demand. The announcement comes as Chancellor Rachel Reeves opens Google's new data centre in Hertfordshire. That's coming later today, apparently. This comes as Donald Trump is set to unveil deals during his state visit that Bloomberg understands could total more than $10 billion. Val.
Well, for more on the $10 billion of deals that we're expecting, we're now joined by Bloomberg's Lucy Meakin. Lucy, what kind of details do we know so far? And is there any prospect that that $10 billion number could grow over the course of this visit?
Well, we can always hope, right? So, as I say, we've got this headline figure of $10 billion that we're expecting. That includes a science and technology partnership. And that should include billions of dollars of new investment, which is key. You always want the new investment. There's also talk of Trump and Starmer unveiling a defence technology pact. And then, as Anna just said, we've already had this Google unveiling £5 billion worth of investment over 2 years for AI development. I think that's going to be largely centred around DeepMind. If you are familiar with their boss, he is British himself. He grew up in North London, not far from where that data centre is, I think. So it's going to be interesting. But yeah, we've got NVIDIA's Jensen Huang, we've got OpenAI's Sam Altman, both coming into town to talk to the Prime Minister. So we could see what we'll get.
Yeah, it's going to be interesting. Yes, I think our colleague Tom McKenzie spoke to Demis Hassabis just last week on some things that DeepMind and his other businesses are doing. We've also, in the UK context then, Lucy, had data out on the UK labour market this morning. A lot of it seemed to be in line with expectations. Any key messages to take away?
I would take away it's cooling, the labour market. But I'd also take away that if we're looking to the Bank of England, firstly, I still don't expect anything this week. And secondly, I think it's actually the inflation data tomorrow that we should look at to take the two in the round if we're going to look at what this will mean for rates. But yeah, certainly cooling. We had payrolls dropping for a 7th month. Wage growth is the lowest level in, I think, 3 years. And vacancies are still dropping, and they were already below pre-pandemic levels.
Lucy, great stuff. Thank you very much indeed. Bloomberg's Lucy Meakin on what is happening here in the UK today and over the next few days. So let's talk about the next few days. Donald Trump's state visits, politically fraught. I think that probably is the understatement of the week. Certainly it comes at a difficult time for the UK Prime Minister, Keir Starmer. He has a lot of navigating to do over the next few days. Peter Westmacott is a former British ambassador to the United States. Peter, what are you expecting from this trip?
Good morning. Well, it's a very high-profile state visit, of course, to state the obvious. It's shorter than most state visits are for a number of reasons, partly because they've all decided that they don't want to have President Trump coming through the streets of London and risking protests and so on, which would make it more difficult. I think what this is really about is a fundamental objective of trying to make President Trump feel positive about the United Kingdom, relations with the UK, and hopefully become a bit more ready to listen to UK arguments on some of the really important global issues where Washington and London are not entirely on the same page. And it is personal. Donald Trump is somebody who has a very personal, transactional, one might say, approach to the presidency. But it's important, therefore, for him to feel that he's had a great time and that the United Kingdom is rather special for him. At the same time, as your correspondent's just been saying, there is the potential for some pretty serious business to be done. The UK is proud of the fact that on AI it is something of a leader, and so we look forward to doing some business as well during the pomp and the ceremony and the protocol and the carriage rides.
Do you think, is the geopolitics the main objective of the Starmer administration? Is a meeting of minds on geopolitics, on what happens in Ukraine or what happens in the Gulf or what happens in other parts of the world the objective here? Or is this more about the transactional nature of the administration's approach, and this is about tariffs and it's about trade and it's about investment? Which do you think of those two things are the greatest priority for the UK administration?
I think it's really hard to decide because both are right now extremely important. The UK government is not in a great place in terms of economic growth, wage levels, productivity, foreign trade, and all those things are difficult. And the United States, most important partner, biggest single trade partner and investment partner for the UK in the world. Donald Trump has been somewhat protectionist with tariff wars and so on, and is a bit whimsical sometimes in the way in which he deals with trading partners. So the UK really wants to firm up, if you like, the much better relations on trade and investment that was visible when Keir Starmer went to the Oval Office. That went well, but there's more work to be done. And this matters hugely to the government's economic agenda, which is faltering a bit. But I don't think we should underplay either the importance of the foreign policy agenda. For the UK, I think European security and Ukraine and standing up to Putin and discouraging him from invading other countries in Europe is really a top foreign policy priority. But I will be very surprised if there isn't also some frank talking about what's going on, Israel, Gaza, Palestine, possibly even Iran, although that at the moment is not the hottest ticket. And then there's China, where there is an important conversation to be had. But it's not, if you like, right now. It's not today's crisis. It's just really important strategically.
Do we think there's any political ground to be made by Prime Minister Keir Starmer in standing up to President Trump on any particular policy area, Peter? I ask this because there was evidence in the Canadian elections and the Norwegian elections that standing up to President Trump on areas where you disagree can pay dividends. Of course, the Prime Minister has taken a very different stance and arguably gained momentum from a very different strategy, a much more conciliatory strategy with the United States. So what would you advise on that front?
I think that the standing up to Donald Trump argument, the Love Actually moment with Hugh Grant, if you like, to reduce it to the cinematographic, is, it's tempting, if you like, as an observer or as for media purposes, but it is not something that works very well with this president. He does not like public criticism, particularly in front of the TV cameras. He likes to be seen to be appreciated. He likes praise, of course. He is transactional, though. He's a deal maker, as he keeps telling us. So I think there are ways in which you can talk to President Trump and try and move him in a direction where you are worried that he's not in private on policy, which are stop short of public criticism. I don't think that works very well. But I do think that in terms of transactions and so on, there are ways in which the United Kingdom can remind him of what the UK brings to the party, and that, we are not free riders like he thinks much of Europe is. The United Kingdom brings a great deal to the party from the point of view of US interests. And I think behind closed doors, there's an awful lot of substance to be discussed in that area.
Yeah, and what if the president decides to weigh in on UK politics, as we saw Elon Musk do over the weekend, perhaps talking about the Unite the Nation rally, as we saw Elon Musk do at the weekend? What would your advice to the Prime Minister be if he starts to do that, perhaps even in a press conference in front of him?
Well, he did it before. I remember back in June, I think it was 2018, when he was rather unhelpful to Theresa May when she was in the middle of difficult Brexit negotiations. He weighed in with an interview with the Sun newspaper, which was really very unhelpful. Was it designed to be helpful? I don't know. I suspect that the president has learnt from experience that this doesn't go down extremely well. He is a host. He is getting an unprecedented second state visit. My guess is he will not want to mess that up. He values his relationship with the royal family. He does appear to have a very strong personal link to Keir Starmer. He will be aware of the political and economic pressures that the government is under, I don't think he'll want to make that difficult. If he does, if something goes wrong, if a wheel falls off by accident, my guess is that Keir Starmer's reaction will be, to shrug and say, kind of, that's life, rather than to make a drama out of a crisis, or the other way around.
Peter, Trump is also bringing about many leaders in tech. We have Jensen Huang, NVIDIA CEO, Apple's Tim Cook is also joining him. Do you see that maybe he's going to want something back for this investment that's being pledged by UK businesses? We know that the president is transactional in nature. Do you think there's something to the other flip side of this card that he's going to ask for?
I'm not aware that there's anything particular. Those investments by Google and DeepMind and OpenAI and the other tech guys and other US companies which are already big investors in the UK, they will not be making those investments unless it's in their own business interest. Will he be looking for UK firms to make comparable investments in the US economy? I don't know. What we do know is that if you want to become a significant defense partner in terms of supplying expensive high-tech defense equipment to the United States, you've got to be making that stuff in America. America imports almost nothing from abroad. You've got to be manufacturing. So it may be that in the defense sector, if we want to thicken up that partnership, that he'll be looking for evidence of significant UK investments. But otherwise, I think he will be looking to see stronger business links. Sometimes that's good for him. Sometimes it's good for his friends. It's certainly good for the UK because it is a significant message of confidence in the future of the British economy.
Peter, it was mentioned that Mandelson was a key part of this tech investing and getting these deals together. Do you think that losing him as a UK ambassador will make a difference in the relations with the US?
I think you're right. He was very much an architect of that technology partnership. He told us all about it. And he has a experience when he was trade commissioner in Brussels of doing serious negotiations. He's quite, I wouldn't say he's a trade wonk, but he's very much skilled in that area. And he was a very successful Secretary of State for Trade and Industry when he was in a previous British government. So he's been very much involved in that. All that said, a great deal of the heavy lifting on these issues is done between White House and 10 Downing Street. Varun Sharma, the Prime Minister's business advisor, has been very much involved in a lot of the tariff stuff and the other trade and investment negotiations. I think Peter Mandelson obviously was an effective ambassador during the months that he was there. But I see no reason why there needs to be any damage, if you like, to the substance of that relationship, provided the United Kingdom chooses somebody fairly soon of sufficient skill and stature to take forward the momentum of the relationship, which at the moment looks set fair. And if the state visit goes well, there will be plenty of good reason, both for smiles on the face of the President and the First Lady, and for the British government to feel that it's been, job well done.
Peter, thank you very much. Thanks for joining us. Former British Ambassador Peter Westmacott, former Ambassador, of course, to the United States. Thank you for joining us. Good to get your perspective. Coming up then, President Trump has also been busy when it comes to the Federal Reserve agenda. He's been blocked, though, from removing Fed Governor Lisa Cook, while Stephen Miran is confirmed to the Central Bank Board. More on what that means for the future of the Fed next. This is Bloomberg.
The president of Apollo Global Management sees plenty of investment opportunities on the continent as governments struggle to meet industrial spending demands. Speaking exclusively to Bloomberg's Francine Lacqua, Jim Zelter said he's particularly interested in Germany.
This is the most unique period of time in Europe. For the first time in decades, I think there's the good thing about this administration is that the memo has been sent out about global growth and responsibility and accountability. And as a leadership in the countries around Europe are trying to figure out what that means for them, there's certainly a conversation that Apollo wants to be a part of, and we find ourselves being the recipient of a lot of dialogues and part of a lot of dialogue. So very exciting time. It's not a clear picture. And like usual, Europe has many different stories in terms of the continent and each country, what their objectives and needs are. But very exciting time for Europe, and we've been very public and pronounced about what our ambitions are, whether it's $100 billion in Germany or several $100 billion around the continent. We believe we're going to be a player in that dialogue.
So where do you see the best deals actually in Europe? And when you talk about dialogue, will that translate into actual money being spent in Europe?
Well, I think before you get to deals, you know, around the globe right now there's this massive global industrial capex needs and global industrial renaissance, which is really the provision of capital for whether it's energy, former utilities, transmission lines, whether it's energy sustainability and the modernization of that, whether it's data centers. You know, we find ourselves in a situation where, you know, for the most part, corporates and consumers, our balance sheets are pretty solid, where governments are a bit more challenged. So I think there's a realization that there's a dramatic need for CapEx, and governments on their own are not the solution. And so, you know, every country in Europe has a different objective in terms of their fiscal policies and their fiscal ambitions. And they have great ambitions, but a limited budget to provide that. So I think as the world of finance continues to evolve, you know, certainly we've been quite active in Germany. Yep. We've been quite active in France. You know, Athora, in their recent announcement of the purchase of PIC in the UK, which is a different conversation. But you know, I think we find ourselves, particularly in those two countries, and yes, some in Italy and some in Scandinavia as well. So it's fairly broad brush, but these are massive, massive ambitions from which to fund.
That was Apollo's Jim Zelter speaking exclusively to Francine Lacqua on the opportunities in Europe for private credit. Well, let's take a look at the risk events on the horizon. Later this morning at 9 a.m., we have the German ZEW survey. Later this afternoon, U.S. retail sales drops at 2:30. At 2:15, U.S. industrial production. And maybe most importantly, the Fed meeting starts today. All 7 governor seats will be taken after Miran's successful confirmation in the Senate yesterday evening.
Yeah, absolutely. So that's certainly something we're focused on. Let's get an opinion on this. We're joined now by Bloomberg opinion columnist John Authers, who's been writing about the Fed. Another dramatic day then in store for the Fed. We've heard about Lisa Cook. Trump's attempts to remove her have failed so far, at least, John. Stephen Miran is going to be there. What difference does it make that Lisa will still be there and Stephen will be joining? What difference does it make, do you think, to the dot plot we're presented with or to the conversation around the table?
Not well, to the conversation around the table, to which unfortunately we're not going to be privy. I would imagine that's going to make a very big, very entertaining difference. Stephen Miran has accused the current governors of tariff derangement syndrome, which isn't very polite of him. He's made a number of very strong criticisms of the Fed, and so he's likely to make somewhat of a pain of himself, one would think, and that will make it quite entertaining. In terms of the dot plot itself, I doubt it will make that much difference. I also doubt that it'll make much difference to the outcome today or tomorrow. The key question at this point is concerning Lisa Cook and whether the attempt to force her off the board can succeed by February, which is when the governors have the opportunity to veto the candidates for the next round of presidents of the regional Feds. And that, if you've got a majority of the 7 governors, which would require Lisa Cook to be replaced by February, then you can also ensure that you have a majority of the overall FOMC by choosing the regional Feds. It's a labyrinthine structure, but that's what really matters. I think the attempt to force her off in time for this week's meeting was more a sign of intent than any real practical impact on what's going to happen this week.
It's really interesting because we all thought initially that it was an attempt maybe to sort of force her off. To change the kind of the rate outlook, but it's a much kind of longer, bigger picture. Maybe attempt by the Trump administration to take over the Fed. And I read the piece this morning, John, fascinating on that front. Would an end to quarterly reporting by US companies be market positive or market negative? I can't figure that one out. What do you think?
A lot would depend on the details. Personally, I actually do think there's quite a lot to be said for moving away from quarterly reporting, because it does indeed encourage a lot of very short-term thinking on the part of managements and actually also of investors. The standard practice in Britain is for annual reporting supplemented by interim reports every 6 months. And I don't think there is any significant lack of transparency in Britain. So this has been something that long-term investment advocates have argued for a while. You'd get somewhat of a limitation on the opportunities for short-term trading strategies around earnings season. You would have to have safeguards such that if companies know that something materially good or bad has happened, they do have to tell you about it in timely fashion outside of the normal reporting cycle. You certainly need quite a lot of thought and detail to go into this. And as I understand it, quarterly reporting is at the moment actually in the law, so you do need Congress as well. So it will take time. But I think it's ultimately market and economy positive.
OK. John, really interesting thoughts as ever. Thank you very much indeed for joining us on television this morning. John Authers, Bloomberg Senior Editor for Markets and Bloomberg Opinion Columnist. It's really interesting what he says about Cook. This is not, like, in some ways it doesn't matter about this meeting. It just matters that she is gone from a White House point of view by the beginning of next year. Today's kind of a red herring in some ways. Well, and isn't going to change the outcome a great deal. Like, she's notionally dovish as well. Yeah,
I was mentioning she's not necessarily a standout hawkish member of the FOMC governing board. But it's just interesting to see this process move along, because this is the first time we've ever seen a president try to remove a governor. And essentially the market is going to get clarity over what is cause to remove somebody and what is not.
And the Supreme Court has previously acknowledged that the Fed is different and that the president isn't as directly in control of them, and therefore that's different and cause matters. But we'll see whether President Trump tries to bring the Supreme Court into this one as well, and we make any movement there. John, in his piece that you referenced, making that point.
We're going to watch, we're going to see what the outcome is. They're all sitting down together. As John says, it would be nice to see, to be a fly on the wall maybe at that meeting. Tension in the room? I would have thought a little bit. Anyway, we're going to continue the conversation here on Bloomberg Television. We're going to count you down to that Fed meeting and its result tomorrow. Francine's up next. The Pulse is up next. This is Bloomberg.